Hi, I'm Bill Walker. We all know that 2011 was a volatile year that for many probably felt like a roller coaster ride. For global managers, this presented both challenges and opportunities. So here to talk about this is the management team of the Trimark Global Fundamental Equity Fund. Michael Hatcher is Director of Research for the fund and lead portfolio manager. He also manages the European portion of the fund. Darren McKiernan manages the North American portion. Darren, thanks for being here. While Jeff Feng manages the Asian and Latin American portion of the fund. Thank you all for being here today. Michael, I wanted to get started with you. You and your team have seen a lot of turmoil in Europe in the last few years. How have you avoided that volatility that we've seen?
Thank you, Bill. And we certainly have seen volatility over the last 2 years. And just to put that in perspective, the European markets have been down over 5% over the last 2 years. We've managed to compound capital within Europe at over 2.5%. And I would say that the biggest difference is we don't manage to an index. We buy companies, we don't buy markets. And we're looking for quality companies that have competitive advantages, that high returns on invested capital and generate cash. I would argue that you want these characteristics in companies in almost any market, but particularly in volatile markets when people are scared, these are the things that are actually going to truly hold their value and compound their value over time.
Let me ask you a form of the same question, Jeff, because we're hearing conflicting information about Latin America and Asia markets in terms of what the prospects for growth are. What are your thoughts about that?
Well, no doubt. The growth there will slowing down. Because the growth rate we saw actually was based on stimulus packages given out by those governments and a sharp rebound of industry demand from very low base in the year of 2008 and 2009. But let's focus on the big pictures. The fundamental drivers of growth in those economies are still there. First of all, very favorable demographic structures. Emerging Asian and Latin American, they all have very young populations. A young population not only means coming large young workforce participating in those economies, but also means first low pension and medical expenditures from companies and governments. Also means increasing consumption powers because you have more people actually earning income. So those factors are still there. Secondly, if you look at the government fiscal situations in those economies, today's situation is totally different from what they were 10, 15 years ago. One important ratio we look at is the government debt to GDP. The rates for those countries are roughly from 30% to 40%, very comfortable compared to, close to 100%, even over 100% in many developed economies. So governments in those economies today do have the dry powder to stimulate their package, to build infrastructures. So that's what we thought. I think in the longer term, those factors will keep driving the growth in those economies.
And I think it's interesting that you mentioned stimulus and also you mentioned other developed countries that may be facing debt issues, because that takes us directly to you, Darren. And I know a lot of people are interested in U.S. and Canada, but the U.S. in particular, there's been a lot of talk about the debt load and the fact that maybe the United States is losing its dominant position in the world. What are your insights?
Yeah, well, it's a good question, Bill. I look at from a developed economy standpoint, I look at the U.S. as the best house in a bad neighborhood. The other houses in the street being, say, Europe and Japan. I think going forward, for sure there's some issues. The debt load, like you mentioned, has to be taken care of. I think entitlement spending has to be reined in, whether it's healthcare or defense. But longer term, actually, I think the U.S. is in a pretty good shape. There's two reasons for that. Jeff mentioned demographics. From a simple demographic standpoint, the U.S. is actually in good shape over the long term. It's got a younger population than other developed nations. From an immigration policy standpoint and just from a simple birth rate standpoint, if you think about over the next 40 years, the U.S. workforce is actually projected to grow over 30% over that time frame. Now compare that to, say, Japan, whose workforce has been declining for years. Europe, over the next 40 years, is going to decline. And in fact, even China is going to run into problems over 20, 25 years due to the one-child policy. So that's one reason. And secondly, at the end of the day, the U.S. is still the world leader in some of the most high-growth industries in the world. If you think technology, think about medical devices, even think about things like renewable resources, the U.S. is still the leader in those industries. And going forward, it's those sort of advantages that are actually going to bode well for long-term economic growth.
Well, and I think what you've done, Darren, in taking it back to Michael, is you've segued us nicely into the opportunities section of this conversation, because it's not all doom and gloom out there. I think the three of you would agree with that. Michael, on Europe, I've heard you often say you look for companies with regular and recurring revenue streams. Can you expand on that? And you look for these companies regardless of how the economy is doing. Talk to us a little bit about that.
I would say that's one of the key traits, that if you can find companies in which customers are continually going back and purchasing that product, or there's a service that's just needed on a reoccurring nature, just regardless of what's going on in the economy, this is something that needs to be consumed. And if I looked within the portfolio, probably the strongest example that I can think of is a company that most people wouldn't actually be familiar with what's on the name, is Schindler. But I will tell you, the next time that you get into an elevator, look around and see who's actually made that elevator. There's 4 global companies, and Schindler is one of them that is the elevator manufacturing to the world. Now, why this is a reoccurring nature is, over 80% of the earnings of this company is elevator maintenance. So regardless of what's going on in the economy, regardless of whether Italy is paying 7% on its debt or whether Italy could default, you need to service elevators. And as a matter of fact, not only do you need to, it's a regulatory requirement. When was the last time that you heard of an elevator accident within Western Europe or in North America? There was one actually in Japan a few years ago, and that made international headlines. So this is an example of a company that will just generate cash flow and strong cash flow in all environments. And when you can understand that, and then you understand how to value that, you have the opportunity to buy this at a discount to what it's worth when the market presents these opportunities.
Jeff, do you see the same kind of outlook applying to Asia and Latin America? And if so, can you list some of the long-term themes for growth and areas that provide opportunity for the fund?
Sure, yeah, we do look at themes. But first, let me emphasize this. We are all bottom-up investors. We focus on individual companies. But we do like actually seal with good tailwind. That's why we look at those themes. One theme we have in the portfolio is actually factory automation. That's an area we think going to have a circular growth driver for the middle term. Because if you look at those developing countries and developed countries, the labor cost is going up rapidly. In China alone, actually, in the last 3 years, the labor cost grew by 15% year over year. So how do you actually, if you are a company there, how do you reduce your actually labor cost or your production cost? In the meantime, maintain your price competitiveness. If you look at the competition globally, as a Chinese company or as Indian companies, you need to actually move up gradually along the value chain, which means you want to produce more value-added products with high quality. So all those require factory automation facilities. So we have a few Japanese companies. They are global leaders in those areas and with very nice, competitive advantages from patents, from know-hows, from the distribution networks they have been building in the last few decades. So that's one theme we have. Another theme we have is what I call the consumption upgrade in developing countries. So we talk about more working force participating economies. So with increased income, people are going to spend their money on some things they haven't spent on or they haven't spent enough on. That's including, either is buying cars from car dealerships or buying insurance products to protect their families, or simply just going out, eat out more. That's another thing. The last one, actually, it's very common, I think, is the commodity demand from those economies because they need more infrastructures to accommodate the future growth. So that's a few things we look at.
But it's different for North America, isn't it, Darren? Can you talk about some of the U.S. names in the portfolio that and the value that these companies could offer as opportunities?
Well, sure. Maybe as opposed to drilling down to a specific name, and in fact, Michael mentioned Schindler. I own a company called United Technologies, which owns Otis Elevators for the exact same reasons why Michael owns Schindler.
So once again, check the elevator when you get in. It's either
right.
Schindler or
It'll be
Otis.
Schindler or Otis, probably.
I think I see Otis more often.
Yeah.
I do see Schindler.
It's a North American
In North
phenomenon.
America, Schindler would be much stronger in Europe.
I see.
Yeah, go to Switzerland. It's all Schindler. Let me step back and look at the U.S. names as a whole, okay, and think about the 23 names that the fund owns, okay, and aggregate them as one stock. Think of it as one stock. Well, that one stock, i.e., those 23 names that the fund owns, right now currently enjoys operating margins, above 25%, has return on equity of 35% plus, a return on invested capital of almost 20%. And what's even more impressive is that these businesses are trading for just over 12 times next year's earnings. Now, put that in a historical context, these very same high-quality businesses, on average, have sold for almost 20 times earnings over their history. So basically, you're buying these incredible franchises at tremendous value. Now, that's just addressing the quality and the valuation. If you think about the safety of the portfolio with respect to the U.S. names, well, on a balance sheet standpoint, over a third of them have net cash on the balance sheet. And even when you incorporate the companies that have debt, they could pay off their entire debt load in less than 1 year's operating income. So it's kind of perverse, but I actually view the U.S. names in the portfolio as having a higher creditworthiness than the U.S. government at this point.
Yeah, that really is, that's quite interesting.
Now, McDonald's doesn't have a printing press, but...
of course not, but it does sound like there are some great opportunities in the North American market, and it leads me to turn back to you, Michael, just to ask you overall, it sounds like there are a lot of opportunities in all three areas that you specialize in, but what should investors expect and advisors expect overall from the fund in 2012?
Well, when you say expectant in 2012, most people think of that as an expectation of returns, and that we just don't know how the year's going to unfold. What I can tell you, what you can expect from us as a team is we are going to continue to upgrade the portfolio on quality companies. And what do I mean by quality companies? You're going to hear me say the same thing over and over and over again. These are companies that have competitive advantages to them, which is just something that stops other people from competing or makes it difficult to compete. They're going to have high returns on invested capital, and they're going to generate significant free cash. I mean, these are the things that you're going to continue to see us upgrade on the portfolio. You're also going to expect from us to see we're going to be very diligent on what I call managing business risk. So we can't tell what the market's going to do. We can't tell whether the market is going to compress multiples and get cheaper or whether the market's going to rebound. But we're going to be very diligent in understanding the companies that we own to make sure that we understand the risk and the cash that our portfolio is actually generating. And I would say the third thing that you can expect from us is you can expect us to be continuing to sort of scour the globe with extensive travel to uncover new opportunities. Whether that's Jeff in Japan or going over to Taiwan, whether that's me over in Switzerland or going to the UK, or whether Darren's going to Kansas or Indiana. But you will see us sort of always looking for new opportunities. And I would say, if depending on how the year unfolds, taking advantage of pessimism, not actually being scared of it. This is a fantastic market to actually find great opportunities because people are generally shying away from what they perceive as risk. It's not risk if you understand the business that you're investing in.
And just to add to Michael, why this structure works, the three of us have been working together for, in some cases, 8 years. So we know how each other think. We understand sort of our blind spots, and we understand business risk. We understand how we look at each other's companies and analyze businesses. And that's a really significant factor, I think, as to why this sort of structure works with respect to the Trimark Global Fundamental Equity Fund.
I mean, these are great points, and it sounds like even though there might be a bit of a bumpy ride still in store this year, that there still are some great opportunities out there if you know where to look for them. And with an experienced team like this, I think that you're headed in the right direction. So gentlemen, thank you. Nice talking to you today. Appreciate you taking the time.
Great, thank you.
Thank you.
It's great to be here.